Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. I'm starting this week's report with a chart of the volatility index, which is ticker symbol VIX, and you can see here in this daily candle chart, this was my forecasted line where I thought we would break over this upper resistance area here, and although we did that on Monday, we didn't go up as high as I thought it would. In fact, it turned down and then retested the support right here. The good news for us right now is that the signals have gotten a little bit clearer, and the chances of the volatility index rallying next week become much greater. In fact, what I'm going to do is redraw my forecast for the S&P here, mainly because we have a bullish engulfing pattern right there. We have a bounce off of the support level, and there's a gap above the market on the VIX. And gaps fill just about 100% of the time on the VIX, and this small little gap will act as a magnet as it draws the price of the VIX up. Now remember, the volatility index is a leading indicator that works contrary to the S&P 500. So I use this as a leading indicator, and that's why I'm starting the video off by looking at the VIX. With that, let's go to the SPY, that's the S&P 500 index, and that's the ETF for the index. And I have drawn a resistance line right here because we stopped today right at that resistance, and we showed a red candle on higher volume. So that's telling us the sellers are getting a little bit more motivated here, and we have a gap below the market in the S&P. So what I'm going to do is mark that gap for you, but then draw a forecast of what I think the S&P could do next week. This is what I'm forecasting, a retest of support and possibly the 200 period moving average. So that's the S&P. I'm going to move on to the diamonds right now. It's ticker symbol DIA. That is the ETF for the Dow. I'll show you, this was my forecast. I thought we would go lower. It did go lower on Monday, but it bounced off of the 200 period moving average. So I guess you could say we were 50% accurate on that one, but I'm going to redraw the line for what I think the diamonds are going to do next week. I think we're going to come right back down to fill that gap, maybe even retest the 200 period moving average. But to play it safe, I'm going to go with the gap fill because the VIX and the S&P are lining up with that same thing with the gap fill target. So watch out, keep your stops in place. We're pulling back from resistance right here in the Dow, which is right around the 17,900 level. Remember, the diamond is 1/100th of the Dow, and that's how we track that. Looking at a more broad-based index in the Russell 2000 index, you can see that again, I did expect the market to drop. It did come down. It did bounce off of the 200 period moving average, and the Russell 2000 gapped up as well. Keep in mind that the Russell 2000 is a more broad-based index, more so than the diamonds, and when you're pulling back from resistance right here, I'll just extend that resistance line out right there. You see the red candle gap below. That means I'm going to redraw my forecast trend for next week right there, and I will erase that trend line to become the new benchmark for trading and even investing. So what does that mean? If we continue to pull back, you have a double top forming right here. In fact, I did a web seminar yesterday talking about double tops with our Canadian clients and through Scotia iTrade, and I think double tops is something you cannot ignore because this is really turning into a more complex head and shoulders pattern. So we have to keep in mind that if a market breaks down below the 200 period moving average, the shift really takes place to the downside. All buyers start to move out and even start taking profits. So it's something that we should pay very close attention to, especially this week. Now, going to the Qs, that's QQQ, you'll see that we have a similar thing happening where we have a bearish engulfing pattern here after a pullback of the resistance line right there. It's almost matching perfectly to the highs. So I'm going to redraw this right here on the Qs, and I'm going to move that just over just a little bit because I think we're going to come right back here. We're kind of in a wedge or even a triangle pattern forming here, so that's a safer bet, expecting a pullback right there. Now, one other thing I want to point out before I move on, and that's really with the Russell 2000. Take a look at that. I want to show you what it looks like on the monthly scale. Remember, there's an old saying, as January goes, so goes the year. And it's pretty amazing because we ended January right there, that red candle in that bearish engulfing pattern. We ended January with a bearish engulfing pattern. So that's making this very, very interesting because we have one bearish engulfing pattern there, another one there, another one there, and now a fourth one, which in my 33 years of experience, I've never seen that many monthly bearish engulfing patterns show up on a chart since I've been in the market. So I don't want to sound like the sky is falling and then you go ahead and see the market rally on a short-term rally. That's not what I'm talking about. Long-term planning and risk management is very much in order right here, and these signals are very obvious to me. Do not ignore those, because when this market finally breaks and goes through major support levels, watch out below. You don't want to get caught long and start giving back all your profits. In fact, what you can do is very easily shift your position into maybe some bearish funds, some exchange trade funds that are more contra funds, and maybe even get into the option markets. There's a lot of opportunity here. You just have to pay very close attention to the signals. Don't get greedy. Don't get overconfident to the upside. Just watch your downside and follow the charts. Have a great weekend, folks. So long.